So let's look at some ratios. There's a liquidity ratios, which basically looks at your cash and the ability to meet your short-term needs as a company. The simplest is working capital, and that's basically taking your current assets and subtracting out your current liabilities. And a positive number in this situation is a good thing, which means you can meet your short-term cash goals. Then we have the current ratio. What this ratio does is basically identifies the same thing, looking at how much current assets you have over current liabilities. In this case, they use the example, you have $26,540 in current assets. You divide that by $5,400 of current liabilities. And this means you have 4.91 times your current assets to your current liabilities. Again, a good ratio. But if you look at these just by themselves, it may not yield useful information. It tells you, yes, you can pay your bills in a timely manner. But what you're really looking at is how do you compare against others in your industry? How do you compare against other companies? As well as have you grown this over time? How has your company adjusted to the current cash situation? So exercise 12, we're going to calculate the working capital and the current ratio. So for the first part, for working capital, you take the $76,000, you subtract out the current liabilities of $48,000, and you have $28,000 in working capital. In the following year, you take the $295,000 in current assets, subtract out $163,500 in current liabilities, which leaves you $131,500 in working capital. Overall, pretty good ratio. Now, looking at the current assets over the current liabilities, you take the $76,000 and divide it up by the $48,000 to come up with 1.58 times. And then the following year, you take the $295,000, divide it by $163,500, and you get 1.8. It looks like over time you're getting better in turning your cash or having enough cash to pay your current liabilities. So let's say you have a landscaping business, you just begun operations. You purchase several pieces of equipment in the first month to get your business started. These purchases reduced your cash on hand, and in turn, your liquidity suffered the following months with low working capital and current ratio. Your business is now in the 8th month of operation, and while you are starting to grow in sales, you're not seeing a significant change in your working capital or current ratio. What could attribute to this stagnancy in your liquidity? The quickest way I look at is looking at the cash conversion cycle or operating cycle we talked about. Maybe you're not collecting money as quickly from customers as you want, or maybe you're spending money faster than you're actually collecting it. How do you change this? Well, you can change the terms to customers or have them pay cash in advance. Or you could change your terms with your vendors and suppliers so that you pay slower to them. All right, now we look at the total cycle, and we've covered everything except number 10. So briefly, we're going to go through some transactions. This should be a refresher for you, so I'll go through them fairly quickly. So we received common stock of $70,000. We debit cash, $70,000, credit common stock, $70,000. Assets increase $70,000. Stockholders' equity increases $70,000. We purchase equipment, $45,000 worth of equipment, some of it for cash and some of it for a payable or on credit. So the equipment is debited, $45,000. Cash is credited, $37,500, and accounts payable is credited, $7,500. So the $45,000 and the $37,500 are netted against each other, and assets increase $7,500 while liabilities increase $7,500. We purchase supplies. Supplies is debited $300 and cash is credited $300. These both impact an asset account. Netting them together, there's $0 impact. Okay. We provide $4,000 in services. We debit accounts receivable $4,000 and credit service revenue $4,000. Our assets increase $4,000 and our stockholders' equity increases $4,000. We pay utility of $75. Utility expenses debited $75. Cash is credited $75. Assets decrease $75 and stockholders' equity decreases $75. We received $3,200 cash in advance from a customer. Cash is debited $3,200. Unearned revenue is credited $3,200. So assets increase $3,200 and liabilities increase $3,200. We distribute $150 in cash dividends. Dividends is debited $150 and cash is credited $150. Assets decrease $150 and stockholders' equity decreases $150. We receive $5,200 in cash from a customer for services rendered. Cash is debited $5,200. Service revenue is credited $5,200. Assets increase $5,200. Stockholders' equity increases $5,200. Cliff paid $2,000 towards his outstanding liability. Accounts payable is debited $2,000 and cash is credited $2,000. Assets decreases by $2,000 and liabilities decreases by $2,000. Cliff paid $4,600 in cash for salaries. Salary expense is debited $4,600 and cash is credited $4,600. Assets decrease $4,600 and stockholders' equity decreases $4,600. A customer from August 10th transaction pays $1,500. Cash is debited $1,500. Accounts receivable is credited $1,500. Both of these impact asset account, so it nets to zero. So here we see the general journal of all the transactions. Looking at the general ledger, we can tally up all the balances. Again, I believe this assumes that this is the first month of operation for this company. From that, we can generate an unadjusted trial balance, pulling these accounts from the general ledger. All right, let's look at some adjusting entries to Cliff Company. So Cliff took inventory supplies and discovered that $250 of supplies remained. So in order to achieve the $250 out of the $300, we have to adjust supplies by $50. So we debit supplies expense by $50 and credit supplies by $50. A decrease to assets by $50 and a decrease to stockholders' equity by $50. The equipment we purchased depreciated $2,500 for the month. Depreciation expense equipment debited $2,500 and accumulated depreciation equipment credited $2,500. Assets decreased by $2,500 and stockholders' equity decreases by $2,500. We performed $1,100 of services in August from the customer of the August 14th transaction. Remember, they paid us $3,200 in advance. So we debit unearned revenue, $1,100, and credit service revenue, $1,100. Liabilities decrease $1,100. Stockholders equity increases $1,100. Reviewing the bank statement, we see that we earned $350 in interest. Interest receivable, debit, $350. Interest revenue, credit, $350. Assets increase $350 and stockholders' equity increases $350. We have Unpaid and previously unrecorded income taxes for the month of $3,400. Income tax expense is debited $3,400, and income tax payable is credited $3,400. Liabilities increase $3,400, and stockholders' equity decreases $3,400. Again, looking at the general journal for all the adjusting transactions. And these balances are transferred to the general ledger. So we see the adjustments made into the general ledger. Now we can develop our adjusted trial balance. From the adjusted trial balance, we can determine what's related to the income statement. So obviously our revenues and expenses, and then netted out, it would be net income of $25. Then we can generate our statement of retained earnings, zero beginning value, $25 net income, dividend of $150. Our ending retained earnings is negative $125. From that, we can generate our balance sheet. The top accounts being pulled off of the adjusted trial balance, and then retained earnings was calculated in the previous slide. All right, now we're going to do the closing entries. In this case, service revenue and interest revenue are debited $10,300 and $350 respectively. This is credited against income summary of $10,650. Then we eliminate the expenses. Income summary is debited $10,625. And supplies expense is credited $50. Depreciation expense for equipment credited $2,500. Income tax expense credited $3,400. Salaries expense credited $4,600, and utility expense credited $75. Then we eliminate the income summary. Income summary is debited $25, and retained earnings is credited $25. The final entry is we eliminate or close the dividend account. Retained earnings is debited $150, and dividends is credited $150. Now looking at our general ledger, we see that we have no longer any service revenue or expenses. It's all been eliminated, as well as the adjustment to retained earnings. So now we can generate a post-closing trial balance based on the information provided and after the closing entries. So in summary, closing entries help prepare the books for the next period. We zero out the balances in the temporary accounts. The temporary accounts being the income statement accounts or profit and loss statement accounts, and the dividend account. The purpose of closing entries, it's necessary for the company to see the accumulation of income period to period and verify data and figures found in the adjusted trial balance. Permanent accounts remain. Basically, those are all the balance sheet accounts except dividends. Temporary accounts are eliminated. We basically record 4 closing entries. We close the revenue. We close the expenses. We close the income summary, and then we close the dividends. After you do the post-closing entries, you can do T accounts to verify that those temporary accounts have been reduced to 0. Then we can do a post-closing trial balance. Basically, this is the balance sheet after your closing entries and becomes your new beginning balance sheet. We've talked about cash versus accrual basis of accounting. We've talked about classified balance sheet, breaking down assets and liabilities into subcategories like current and long-term classifications. We talked about the liquidity ratios and what they mean for cash and the ability to pay short-term debt. We talked about working capital and the current ratio. And that concludes this chapter. If you have any questions, please let me know.